Adrian, great to have you back on ET Now. Thank you for joining us. Adrian, Indian markets have done well for themselves this year, and if I look at the emerging market basket, we are the second best performing market this year after UAE. What does that mean for you and your fund? Do you think Indian markets are looking stretched, or this is a beginning of a long-term trend?
I think it's difficult to extrapolate what you see in the markets with the long-term trend within India, though. I think there is a lot of volatility in the market, and I think we do get stretches of time over the last 6-7 quarters where markets have bounced a lot faster than we expected to, and has gotten a lot longer for what we expected to. And I think given the volatility you've seen in the region, not just in India, I would be cautious about extrapolating India's performance from here on. I think that we need to be reasonably cautious, but there are some structural shifts that give us good potential for sustained levels of growth in the Indian market as well. And I think there are some silver linings in the Indian market, but as a whole, I would tread carefully going forward and extrapolating numbers from here.
When you say structural shift, are you referring to the structural shift which has happened in IT, or the structural shift which is now happening as far as the cyclical stocks and the capex dominated economy is concerned?
Yeah, there are 2-3 groups and 2-3 clusters of interesting stocks that are doing quite well at this point in time. When I talk about structural shift, the one that came to mind more was the recent flurry of initial public offerings that are coming from the online space, where after quite a long period where we've had quite a few private companies with interesting business models that are predicated on the shift of consumer behavior from the online space to online ordering of products and services, you're seeing a certain level of maturity, scale, and depth in some of these offerings now. Things like Zomato, for example, that came out a couple of weeks ago. So I think those are the structural shifts that are interesting. They are not necessarily cheap when you look at valuations, but they are real and interesting shifts in the way the market is evolving in India at this point in time. These structural shifts are not the only ideas out there as well. There are some recovery plays. There are some commodity plays that are attracting attention. And like you just mentioned earlier in your program, there are also consumer discretionary plays like real estate that has gone through a flurry of enthusiasm in the Indian market recently.
Okay. Adrian, you've been a long-term believer and investor in Indian private banks, and your portfolio in a sense captures that. But we are getting now signs of stress, especially on the retail book, which in a sense has been the good part for a HDFC Bank or a Kotak Bank or ICICI Bank. Can one ignore the uptick what these banks have reported last quarter, especially on the retail book?
Yeah, there are some. I mean, there's some. We hold three financial holdings over the last 2-3 years that have been the core of our holdings within the financial space, and that would be HDFC Bank, Kotak Mahindra, Kotak Bank, like you say. There are some signs of stress. I think these are real. These are some real signs of stress. The regulatory environment and the banking environment has been supportive to make sure that some of these stress lines are mitigated and there's enough liquidity in the system. But some of these stress faults are real, and it depends on how the signs and the recovery post-COVID would look like. I think that introduces quite a bit of uncertainty into the shape and the pace of recovery from severe COVID, and that's something that any portfolio needs to adjust for as well. Longer term, though, those banks are things that we even in the medium term, even in the next year and a half, 2 years, these banks have a lot of qualities that we like. And common factors include a strong distribution network, very good management teams, very professional management teams, and credit controls that are as good as they come, not just in India, but in the region as well. So these are real qualities that you like to have in your financial institutions. But they are not for everybody. If people are looking for a one-month play or a two-week play, it may not be something that would fructify within that short time frame. But if you have a longer term time frame and you're interested in buying good quality businesses with access to underlying sustained growth over the longer term, I think those three stocks would be things that you would consider seriously.
Adrian, hi, morning. I'm curious to know why Bharti, because it doesn't seem like the government is going to let the sector go into a duopoly. Having said that, while the sector is definitely grappling with a lot of AGR dues and there's a tussle on between the Department of Telecom, the government and the incumbents, but why Bharti?
That's a good question. Why telcos at all? Sometimes if you look at the news flow and you look at the amount of aggression in the market and the loss of value in that sector, it's something that we struggle with as well. Why telcos in India? Over the last few years, we've gone through a difficult time and for telcos, and we've seen various levels of destruction, value destruction. We've seen some very strong volatility that comes from the operating environment that's quite uncertain as well. And there are periods of time when we are out of the telecoms market completely. So we think that about in 2000, in second half of 2019, where we saw some early signs of market repair, we were still quite cautious about the telecoms market. But I think over the last 5-6 quarters, we've seen that the worst seems to be over in terms of market aggression, and there is a steady form of market repair and a more rational telecoms market. Among the three that we could buy, we prefer Bharti the best. We like its management team, we like its strategy, we like its focus and its ability to execute. We also like the quality of its customer base and the fact that it has pricing power and it offers good value for money for what it does, and the quality of its reception and coverage. So all those things are things that we like about the company. But we remain cautious about the sector. The sector is a difficult one to anticipate, not just in India, but in the region as well, where there is quite a lot of regulatory intervention and the ecosystem is always evolving. In almost every market, if you look back 10 years, the number of players would have rationalized. If you look back 20 years, the number of players would have increased. And it's an environment where you have a measured, cautious approach. And then because of the sector and the dynamics of wanting to make sure that you regulate so that the consumers get good value for what they're paying for, it can be very challenging. But at the moment, we like the sustained hypothesis of market repair within India. And among the three, we think Bharti is the best risk-return balance.
Adrian, you just alluded earlier to the fact that the recent flurry of internet IPOs are an indication of a structural shift. Just as an investor who's got a fisheye lens and perhaps has monitored some of the other global platform companies as well, we've got a Zomato, which was the recently listed one, the Indian food delivery aggregator. You've got Nykaa, you've got Policy Bazaar. It's a strong lineup of these internet companies which are slated to IPO this year itself. Wanted to understand, in your experience, are valuations really a fair parameter to judge these companies? Because, it somewhat reminds you of Amazon 10 years back when they were loss-making. but the market sort of spotted the opportunity. At least that was been the case with the recently listed Zomato here back home, because the stock doubled in just 2 days of its listing. So as an investor, A, how closely are you monitoring this space, and B, is valuation ever going to be a concern with you? Because some of these IPOs definitely are pretty richly valued.
Yeah. Valuations are always a concern to us, but depending on the business model and the life cycle and the sector, we need to adjust for which methodologies work the best for the ideas that we are exploring. All the names that you mentioned about are very strong names within the internet space and the internet ecosystem. We are doing work on all of them. We're trying to keep up with what's happening in a very dynamic space. But those names that you mentioned have distinguished themselves from their peer group and are already in the market. When it comes down to valuations, it is a very tricky call, like you say. Often it's a sign of the maturity of the capital markets that it accepts a certain level or certain groups of IPO ideas like this, where earnings we don't really have a strong or long track record of earnings yet. And you do need to weigh the strength of each stock on the basis of its ability to execute in the future and its ability to ride and sustain underlying levels of growth that are reasonably high. There we look at the different types of methodologies. We look at, instead of looking at earnings multiples or EBIT multiples, you tend to look at revenue multiples. You tend to look out to the future more. Then you look at the present level of cash flows and earnings. And that's something that we need to get reasonably comfortable with. When you do this, and then you look at earnings multiples that are applied in the more traditional business models, you will not get a similar level of comfort for valuations. It is always a lot more challenging when you don't have a base level of earnings to depend on, and when you're looking at future growth. So here we do need to test the hypothesis more rigorously. We need to form our own opinions, and then we need to make sure that although we get some exposure, we will, our portfolio. HDFC is about 8.5, depending on the time, depending on what else in the market, can be about 8.5, 9.5% of the portfolio. Stocks like Zomato, until it generates earnings and good cash flows over a steady period of time, and valuations measure that accurately, it's not going to be 8-9% of our portfolio anytime soon. So there are various ways to manage that risk, but I think structurally these things are interesting ideas that will become increasingly dominant. At this point in time, these ideas are collectively less than 5% of any kind of benchmark we look at in India. But in the next 5-10 years, who's to say they won't be 15-20% of the benchmark by then, and a very large part of the capital markets then. So we cannot ignore these things, but you do need to do your work, and you do need to be very selective.
Fair point. The other tectonic shift, Adrian, perhaps, which is happening is in the Indian residential market. While, of course, the basic push comes in that all of us are working from home, we need larger homes, yes. But the other factor is also affordability. Select states have undertaken stamp duty cuts, and more importantly, interest rates as well are at an all-time low. That said, the big problem with the Indian real estate majors also seems to be the large portion of debt on their balance sheets. What are your views about how the Indian realty space should be viewed?
Well, I think real estate is an interesting opportunity in itself, but I think you do need to be very selective. Some of the things you mentioned are things that we worry about. It is very interest rate sensitive. It is very unevenly regulated. The states have a big say, and the level of transparency, the level of protection for the homeowner, the level of protection for mortgages can vary quite a lot state to state. So the state differences, the gearing levels, the interest rates are things that we have to pay attention to. but the underlying opportunity is large. And therefore, actually, it's quite nice to be a stock picker. So I don't need to buy into Indian real estate as a group, as a collective, but I can pick, different stocks that fit what I'm looking for in risk and return profile. And here, I think it's really important to know your developers well. Not every developer has a similar reputation. Some are good at the high end, some are good at the mass market, some are good at delivering projects on time, on target, and some of them are just no good at all. So, as investors, we need to be very selective about what we want, but the underlying opportunity is a very attractive one. You do need to be very cautious about what you pick.
Paints which you have or an HUL which you have, those were in a sense the classic compounders. Consumer companies with high ROCs, they became like the go-to trades for investors. Do you think that trade will continue this decade as well, next 4-5 years? Can these great consumer companies of India, the enviable franchises, can they give double-digit stock returns?
That's very difficult to say. That's why we pay attention to their quarterly numbers. We pay attention to their year-to-year numbers. We listen to what they've got to say, and you can't buy them and then forget about them over 5 years. I don't think. I think even in India, where there's a lot of traditional business models, you can't do that with stocks. You do need to pay attention to them. What they've got going for them is that they've got very strong and known brands that resonate with the Indian consumer. Not everything from a multinational would resonate with the local consumer base and marketplace. And they do have Leavers and Nestle have very strong brands and very strong products, which the average Indian like, and will pay a slight premium for. Not too much, but will pay a slight premium for. These companies don't rest on their laurels, so they're always looking at ways to improve efficiency, deliver more freshness, ensure the quality of their products, make sure inventory levels are optimal, make sure that they drive costs down, and make sure that their advertising, promotion, their communication spend is well spent. And over the last few years, there have been quite a few changes to their business environment as well, where we've seen some challenges in distribution, for example, in GST operations, for example, and they've come out doing well, maintaining their market share, delivering better margins, and so I think they have got they have a lot of good qualities, but they're not resting on their laurels, and that's what we like them for. They do have competitive advantages, but to make sure that this is sustainable over the medium term and long term, they do need to pay attention to how the market is evolving, how the Indian consumer is evolving in terms of taste and sophistication as well. And that's something that we continuously evaluate and test.
That the new IPOs are indicating to a structural shift, and you've participated in some of the IPOs. What I'm trying to understand from you, again, maybe a repeat of the same point because I don't want to get this one wrong, is that do you think some of these consumer internet companies should be a must-have for investors in India? Because globally, some of these consumer internet companies have got listed. In China, some of the consumer internet companies are going through their own process of regulatory changes. Does that make Indian consumer companies a must-have, and one should have 5 to 10% allocation in some of these companies?
Without knowing that your viewership base, it's very difficult. I don't think any stock is a must-have. And the Indian markets are so deep and wide, and the average investor have access to small caps and penny stocks as well. Nothing is a must-have. There's always an alternative. So the first thing I would say is that the headline is nothing is a must-have, and Indian internet consumer stocks, also that's no exception. You contrast that with the Chinese internet consumer plays, and there are a few things to think about there. Quite a few differences there. You are right in the sense that people, look at the Chinese headlines and then say, well, India's next, and then that's during good times. And then during difficult times, they look at the Chinese headlines and they go, well, India's next too. But there are some differences there. Number one is the scale of the Chinese companies are much larger than what we have in India. The second difference would be that the technology infrastructure coverage is a lot higher in China and in India as well. And in terms of converting an internet-aware person into an internet online user that actually, transacts online, the level of penetration in India is much lower than what you get in China as well. So when you put all of that together, some analysts have said it's India is 3 years behind. Some analysts say it's 10 years behind, 5 years behind. I think the broad consensus is that India is behind, but that doesn't mean that it will develop and develop in the way and follow its Chinese counterparts as well. So Zomato may not follow what Meituan went through, for example, and an e-commerce business may not follow what Baba went through as well. And some of these differences are really important. And what you get currently, for example, that's creating weakness in the Chinese market is the level of wariness for antitrust pressures as well. And the regulators are very mindful that with the amount of innovation that has come to place and taken quite a bit of market share, that the man on the street's interest will be compromised. And this is not unique to China as well, but the Indian development and the route can be very, very different from the Chinese experience. So it's good to attract attention. It's good to throw a light on some of these ideas by looking at examples abroad. But after that, you do need to look at your own circumstance and your own companies and your own IPOs and see whether that makes sense to you or not. And none of these are must-haves in my point of view.
So Adrian, I want to remind our viewers, and since you're on the show, that I remember when we engaged into a conversation 10 and 11 years ago, you said, I'm very excited about financials, and HDFC Limited was one of your top holdings. What is that structural large allocation for one of the biggest FI investor for next couple of quarters? Markets may go up and down, stocks may go up and down because of variety of factors, but where do you think that you are either excited about value or you're excited about growth?
I think India gives you an opportunity to participate in both broad groups of drivers. I think there are certain parts that are certain times in the cycle you see more value ideas. Like currently with the rally that you currently see, you see a few more growth ideas, and with the prices that you're getting back, some of that growth will be structural, like the internet consumer stocks, and some of that growth will be from a recovery from a difficult 2020 and what is looking like not a full recovery in 2021 or even the first half of 2022 as well. So I think there are more growthy ideas in the shorter term, but these things come in cycles, and I think India offers depth and variety to pick out ideas whichever way you're biased or inclined.
All right. So Adrian, right now, in terms of where you see opportunity for India, I know you mentioned, some of the internet stocks, which we've been talking about, of course, in depth. Do you continue to see opportunity in some of the banks, for the long term? And where else do you see return potential going forward for India? And let's consider medium and long term.
Well, medium and long term, yeah, it depends on what your definition. So if I were to define long term as 5 years, 4 or 5 years, even 3 years, and then medium would say within 1 to 3 years. I don't think my medium and long term ideas are any different, are substantially different. I see them in banks, I see them in the software companies that we have in India, and I see them in some consumer stocks, some of that internet consumer stocks, some of that traditional Indian consumer stocks. Those would be the 3 large baskets. And if you look at our portfolio, those would make up about anywhere between 18 to 25% of the portfolio. So that would make up about 75 to 80% of our exposure in India. So still quite a lot of opportunity. The interesting thing is that 10 years back, when we had this conversation in a slightly similar way, it's come to fruition, and yet the potential remains, pushed back, and you can see that many of these broad-based trends will continue to have some legs for a while yet.
All right. So banks, software companies, and the consumer stocks, internet and what we call as traditional consumer stocks, that's on Adrian's radar for India. Adrian, we leave it at that. Once again, appreciate your time. Thank you so much for joining us this morning on ET Now.
Thank you. Thank you very much.